record to computer.
Danny, one request, Danny.
Sir, please, sir.
My regular phone 9840555085, ma'am has taken.
Okay, sir.
So the other one is there. I'm just dialing that in case there is any issue. Do you get my call? Another number 98402666085 like call pandren.
Sir, 98402
085.
085. Yes, sir. I have noted, sir. Yes, sir.
The number you are calling is either switched off.
Unga number is switched off nu varudhu. I tried.
Yes.
Okay,
Yes.
okay. No problem. In case I have that this phone with me in front
Yes,
of
sir.
me.
Sure, sir.
Looks
Yes,
like we
current ponana sir. Else will be everything will be correct.
Today it has happened almost 3 times since morning. And so I took liberty to request you to have me connected both in the desktop and the laptop so that if anything happens, then at least I will not waste so much of time of any of the members.
Most of the members camera turn off sir.
Nowadays they know what to do, no? All of us are slowly getting used to the new way.
New normal.
Yeah, new normal.
Yes, sir.
But we don't know what will be the new normal tomorrow, no, Danny?
Sir.
Every day it seems to be changing.
Yes, sir.
Sir, நம்ம ஸ்டார்ட் பண்ணிடலாமா சார்? மெம்பர்ஸ் ஸ்லோவா ஜாயின் பண்ணிக்கலாம். A very good evening to one and all present here. I welcome all the members for today's virtual meeting, and I welcome our today's speaker, CA Kandasami sir, all along from Chennai for this virtual meeting. Hearty welcome, sir. Hearty welcome to my
Thank you. Thank you.
And I welcome CA Daniel sir, our panelist today for today's session. Welcome, sir.
Thank you.
So we all know that CA Kandasami sir is having expertise and in-depth knowledge, especially in the area of non-profit organization. So we have the right resource person with us today to give value addition to all our members. So thank you, sir. Thank you for accepting our invite in spite of your busy schedule, sir. Thank you. And regarding today's session, sir will be covering all the amendments in Foreign Contribution Regulations Act and the Tamil Nadu Public Trust Act, but the bill has not been passed yet. So the purpose of this session is to give an awareness, or it will be like an eye-opener session in Tamil Nadu Public Trust Bill. And third part will be on key issues faced while filing ITR 7 and what will be the consequences and what precautions we can take when the columns of ITR 7 is strongly filled up. And I hope that today's session will be of great value additions to all of us. So as usual, kindly type your queries in the chat box. Sir, we shall have it at the end of the session, right? The queries.
Sure. That's absolutely fine with me, Chairperson.
Now I request CA Daniel sir to give an introduction about CA Kandasami sir. Over to you, sir.
Thank you, Chairman. கந்தசாமி சாருக்கு அறிமுகம் தேவையில்லை. இந்தியா முழுவதும் எந்த சார்ட்டர்ட் அக்கௌண்டன்ட்ஸ் என்பிஓ பற்றி பேசுகிறாங்களோ அவங்களுக்கு சாரோட அறிமுகம் ரொம்ப நல்லாவே தெரியும். பட் இருந்தாலும் ஒரு புரோட்டோகால் இருக்கு, நம்ம சார் அறிமுகம் செய்ய வேண்டும். இட்ஸ் மை பிளஷர் அண்ட் ப்ரிவிலேஜ் டு இன்ட்ரடியூஸ் தி ஸ்பீக்கர் ஆஃப் த டே, CA and Dr. M. Kandasami sir. He is a commerce graduate from Loyola College with several medals for his academic excellence. He is a qualified chartered accountant and also a qualified system auditor. He holds a doctorate in the area of governance engagement in the financial management of NPOs. His field of specialization is governance, financial management, and legal compliance aspects of NPOs. He is a founder and managing partner of Kandasami and Associates. For the last 4 decades, his firm is engaged in providing audit, advisory, consulting, financial management, legal compliance, governance, and related services, exclusively non-profit organizations in India and several other Asian and African countries. His firm helps NPOs to structure and set up legal entities and to comply with legal and regulatory requirements, including income tax, service tax, Companies Act, Societies Act, FCRA, FEMA, etc., and strengthen their governance, financial management, and fundraising capabilities. He has co-authored the first ever book on Foreign Contribution Regulation Act. He has also written a popular book known as Governance and Financial Management in NPO. He has written a manual on audit of public trust for ICI. The latest and unique book, GST for NPOs, co-authored together with his daughter, CA Maria Preeti, is well received by educational, health, and social service bodies. He has been a member in different committees of SARC and ICI over the years, including founder member in the NPO committee of ICI New Delhi. He has contributed to the Society on Charities Administration for the Planning Commission, Government of India. He provides advisory services for national and international funding agencies. He is a sought-after trainer and resource person at national and international seminars and workshops, including government departments, such as the Income Tax Department, National Academy of Direct Taxes. He also facilitates interface meetings between NPOs and government departments, such as Income Tax Department, to bring about closer and mutually enriching relationship between social sector bodies and government agencies for mutual benefit and promote qualitative service to the society. He has facilitated forming an auditors network for NPOs in India, in Asian and African countries. Based on the above experience, he has co-authored a manual known as FMCB manual, which is in global circulation. With these few words, I introduce the today's speaker, Dr. CA M. Kandasami, to our members. Thank you.
Thank you, sir. Over to you, sir.
Thank you. Respected Chairperson, CA Abhinaya, your team members, the office bearers of Madurai ICII SIRC branch, my dear younger brother Danny, who was kind enough to introduce me, and also I can see there are several senior members of the branch, and also brothers and sisters who have joined this evening. To all of you, I wish you a pleasant evening. At the outset, Chairperson, I wish to thank you for introducing me to this topic in your branch. I know that by my last more than 20 years of involvement, Madurai branch is actually a branch with tremendous expertise for non-profit organizations. You have already several resource persons, several members who are deeply committed and very seriously involved in supporting, advising, helping non-profit organizations. In fact, the southern part of our state has got most number of NPOs working at the grassroots level, in and around Madurai in the rural areas, and down south, Thoothukudi, Tirunelveli, Kanyakumari, Kota, that whole area, lot of NPOs are working. The speciality of those NPOs are that they are working at the grassroots level. There are small NGOs, there are medium NGOs, there are also quite a few large NGOs working in and around Madurai and very specially southern part of Tamil Nadu. Naturally, the members of Madurai branch are connected with several of these NPOs and giving wonderful support. I'm also aware that quite a few of the members, I have the privilege of relating with them, discussing with them, and also learning from them. And as you all know, you also have wonderful resource persons. For example, on the 21st of September, the initiative for the SIRC wide seminar on the new amendments of Finance Act 2020 for NPOs came from Madurai. Danny, who just introduced me, was the person who initiated, and our chairman immediately called for that workshop, and I joined, and we had a very large workshop, and we had so many queries. We could only clarify half or less than half of the queries on that day, the 21st of September. I also came to know from our respected chairperson that on the 7th of October, you had a wonderful session, a very detailed session on the income tax provisions for NPOs, none other than Mr. Daniel Selvaraj. I want to congratulate you, Chairperson, for having such a wonderful session. And I heard that such a lot of participation, and it was very, very highly appreciated. My hearty congratulations, Danny, for sharing such a wonderful knowledge. I am almost helpless to mention that he has been associated with me from long time, more than 25 years. Am I right? At least 25 years?
Yes, sir.
Oh, deeply with a tremendous passion, in any aspect of the NPO, whether it is income tax or FCRA or anything that comes up in the NPO sector, he is there, and he was one of the first ones to relate with me. And we have been working in several issues in not only in India, in several other countries. Also, before I proceed to the topic, I also want to congratulate you, respected chairperson. You have made a history by becoming the first, woman chairperson in a branch that is how many years old? To my knowledge, 60 years at least.
Must be
The branch, Madurai branch, is 60 years or 50 years.
50 around, I think.
Yeah, so my hearty congratulations to you. My hearty
Thank you, sir.
congratulations to you. We are all proud of you. And I personally want to congratulate you and thank you for, taking up NPO topics one after another. Last a couple of weeks back, the entire income tax through a very, very good resource person, Mr. Danny Selvaraj, and then again on the now FCRA.
I think the current has been gone. So he'll be connecting.
he'll be back.
Sir, I think both the connections has been lost, sir. I think he given one number, no, sir. We can try in that. Yes, sir. He came back, sir. Can you please unmute yourself, sir?
current போயிட்டது, but I have come on the laptop, see Abhinaya.
Yes, sir, your voice is audible.
Yeah. I don't know why today it has been so many times. There is some power in the laptop, and also I'm keeping the mobile hotspot on.
Okay, sir. Okay.
Kindly excuse me. This is happening few times in Nungambakam in Chennai.
Yes, sir, it is unavoidable, sir. So we can't do anything.
Yeah. So I want to move on to the topic after expressing my delight about. I'm sharing here.
Yes, sir. Please go ahead, sir.
Is it sharing?
Yes, sir. It is. Go to the full screen mode, sir.
Is it sharing?
Yes, sir. It is visible.
Okay. So, Chairperson, as you have already introduced, 3 topics we are trying to cover this evening. The FCRA Amendment 2020, the Tamil Nadu Public Trust Act, which is not yet become an act, it's a bill, but it is passed in the Assembly and waiting for the Governor's approval. Issues in form number ITR 7 and implications of these 3 topics for the non-profit organizations. With 3 objectives. Number 1, to bring about an awareness on the FCRA Amendments 2020, to share an overview on the Tamil Nadu Public Trust Bill, which has got serious implications. And third, supposed to be a detailed analysis of the issues in form number ITR 7. Now, moving to the first topic, FCRA 2010, which was the completely new act repealing the 1976 Act, was in vogue for 10 years. Now in 2020, on the 28th of September, they have brought up the new amendment, that is the 2020, and there are important few amendments, but there are serious implications for the NPOs. I thought our focus can be what has changed. Instead of going to what is not changed, go to what is changed. I have put it like this: not changed in white and changed in red. So quickly moving to what is changed. For example, in the definition, just one change, that is public servant is an addition in the definition. In prohibitions, there is one addition, that is the public servant. And third one, transfer of FCRA funds to one to the other FCRA is prohibited. What we call in the income tax, the intertrust transfer has also happened here. It is now prohibited. This has got huge implication to the non-profit sector in the country. And the next is a restriction on the administrative expenditure. There was already a restriction. Now there is additional restriction. Registration and prayer permission remain the same. Suspension and cancellation. Suspension, there is a small change. Renewal and the registration, there is a change. The inquiry will be conducted. Designated bank account, there is a complete change. We'll discuss that. Maintenance and audit of accounts, there is no change. In all these 4, intimation of change of key members, intimation of annual report or quarterly display, annual display, absolutely no change. Chairperson, can you see the full PPT or partially? Because I can see pictures there. Now is it full PPT?
Sir, for us it will be very full screen will be visible, sir.
Okay.
For you, our box, யாரோட கேமரா ஆன் ஆயிருக்கோ அந்த பாக்ஸும் சேர்ந்து விசிபிள் ஆகும்.
Okay. No problem. Thank you. So we move to what is being changed. Since we have 3 topics, I thought we should move faster. So we move to what is changed. Prohibition of FCRA funds from one body to another. Threshold on the administrative expenditure is restricted 50%. It is now reduced to 20%. FCRA designated bank account, there is a complete change. both for existing organizations as well as organizations who will be applying for registration or prior permission. Public servants are debarred, that is in section 3. Enquiry will be conducted also for renewal, not only for registration. Registration already such an inquiry has and that is a new section. Aadhaar, copy of passports, OCI, etc. is becoming mandatory for the board members. And for prior permission, there are additional requirements now brought in by the amendment. And the suspension period so far is 180 days. Now they have added another 180 days. So they have 360 days for the investigation during the suspension period. And there is no provision for surrender of FCRA registration so far. So they have brought in now a provision for surrender of FCRA registration. Now, moving quickly on these important amendments, as you know, those are the three which directly affect the NPOs, non-profit organizations. First one is prohibition of inter-NPO transfer of FCRA funds, which is in section 7. Currently, an FCRA body cannot transfer FCR even to a FCRA registered body. FCRA transfer includes the cash and in-kind also. Transfer of non-FCRA body with permission is also not permissible. See, so far, we can transfer FCRA funds from one FCRA body to another FCRA body, subject to other conditions are fulfilled, such as the objects are similar and under the income tax, both have 12A, etc. Now, the amendment says you cannot transfer FCRA funds even to another FCRA registered body. Now, FCRA transfer includes not only currency, cash, but also in kind. This is going to cause a lot of problems. We will see that a little later. Transfer to a non-FCRA body with permission was possible before through FC5 by applying through FC5. That is also prohibited now. So donor agencies raising and redistributing FC money, they are going to face, already they are facing a lot of problem. Lead agencies in the NGO networks who used to get the money and pass on to the other members of the network, they cannot do that. Larger NPOs raising funds for smaller NGOs, that is also going to be difficult now. NPO fundraising online platforms who used to raise the money and transfer to the other NPOs. If it is a foreign money, that is going to be difficult for them. What are the options? For us as professionals, it may not be sufficient just to understand the problems. We have to look for ways forward. In the last 1 month plus, I have been observing NPO leadership coming out with the tremendous creativity and innovation, how to go about meeting the new requirements. I have been amazed by the kind of proposals they are bringing, by the kind of suggestions that they are bringing. I am here just to share one or two things. And I'm sure we as a professional community, we can join them and find ways forward. Ways forward not for circumventing the law, ways forward not for a violation of the law, but ways forward for complying with the law within the legal framework of the amendments. Practical issues are going to be NPOs making payments to for-profits. Is it possible? INGOs placing personnel in India. Is it possible? Assets created out of FCRA funds, if they have to be transferred to another entity, is it possible? Conversion of NPOs with FCRA assets. If an NPO has to be converted, is it possible? Merger is possible. All these are going to be issues. To make it quick, NPOs making payments to for-profits is possible, but not for implementation of the program, for services, for obtaining services, consultancy, or other such commercial transactions are possible, but not for implementing programs. International NGOs placing personnel in India, very much possible, completely under a different set of circumstances. That will be a commercial transaction, and that will be covered by FEMA, and that will be covered by the Income Tax Act and not under the FCRA. Assets created out of FCRA funds, how to deal with them, that depends upon what you want to do. If you want to transfer to another entity, then there is a prohibition. Even if you want to merge it with another entity, there is a possibly this section will come into play. And of course, the same thing applies for conversion of NPOs with the FCRA assets. Now, mergers and takeovers and amalgamations which are happening in the non-profit sector, sometimes it is happening faster than the for-profit sector. If it is involving FCRA assets or FCRA funds, it's going to be a problem. Making direct disbursal by the international agency to the FCRA bodies in India is very much possible. There is no problem. There are two other concepts, I have been receiving this query from so many people last 2-3 weeks. That is, can we reimburse the expenditure? Can we advance for the program? See, here we have to be careful. If the reimbursement is to the organization implementing the program with FCRA number, there is absolutely no problem. A staff spends the money and the organization reimburses the money. But if the reimbursement is by another entity with FCRA number or without FCRA registration, and if this FCRA body wants to reimburse the expenditure, then it will be caught within the mischief of the amended provisions. Same thing applicable for advance for programs. If the organization makes advances for its own programs in the course of its implementation, I do not see any problem at all. But if the advances are to another entity with FCRA or without FCRA, and that is for implementation of the program, definitely, in my opinion, it will fall into the mischief of this section. Now, there are so many issues that can arise there because it has got a huge implication. I leave it there, and I request the respected members, if you would like to discuss specific points in relation to the prohibition of the intertrust FCRA funds, I welcome at the end of the session. I move on to the next, that is threshold reduction in the administration expenditure. As we said, it was 50%. Now it has become 20%. I have a comment here. Internationally, administration expenditure is a very important factor in the non-profit sector for assessing the efficiency of the non-profit organization. For example, in Europe and North America, when they are measuring the efficiency of an NPO, they look at the administrative expenditure. If the administrative expenditure is very low, they consider that as an efficient charity. If the administrative expenditure is high, they consider that as an inefficient charity, spending a lot of money on themselves and not on the programs or the people. This is a concept. Now, coming to Asian countries, I'm aware by my own experience in other countries such as the Philippines, long time since, more than 20-30 years, there are regulations there that administrative expenditure should be within certain norms. I remember when I was visiting there 30 years back or 25 years back, it was 30%. And then after 10 years, in the last 10 years, it is now 20%. So India also has brought more or less the same rate, that is 20%. I consider even this 20% to be quite high as an administrative expenditure. But I should be fair. This is a general statement. I should not make such a general statement because it depends upon the reality of each NPO. For example, there is an NPO who may be having excellent program, but they may not have local money for administration. Therefore, they may be using foreign money, and there may be a donor who is funding the administrative expenditure. So in that case, if you look at only the foreign money, which you have to, according to the provisions of the FCRA, it will be only admin cost. It is not fair for me to say that this charity is spending high percentage of admin cost. We have to see in the overall financial structure, in the overall expenditure, what is finally the administration cost. If that is low, the fact it is high in the FC account, or it is more in another program, one program, and less in another program, those are all not the important. Finally, what matters is at an average, what is the administrative cost for an organization. However, this is going to cause a lot of problems to some of the NGOs. For example, NGOs with huge staff, they are going to find it difficult. NGOs with a small budget, nominal budget, They are also going to find it difficult. Already they are finding it difficult. And those with the overhead expenditure, those who are spending on fixed assets, for example, they also will be hit by this restriction. And lobbying and advocacy bodies, this is a debatable because lobbying and advocacy bodies, their program itself is salaries for the persons, activists who are lobbying and doing the advocacy. Now, whether that salary should be presented as a admin cost or a program cost is a question. Using now, what are some ways forward? I am not going to so many other aspects. For example, Rule 5 of the FCRA Rule 2011 defines what are the admin costs. It speaks about salaries, it speaks about management people's cost, etc., etc. But it excludes cost of research. If people are involved in research or people are involved in training, it excludes the salaries, and other expenditures can be considered as program expenditure. Similarly, welfare related expenditures will not be taken to admin at all. They will be directly, for example, in a school, the staff salary, in a hospital, the doctor's salary will not be considered as a admin at all, because they are for the program and they will be considered as a program cost. I would like to share some ways forward that are already coming up in the non-profit sector. Number one, try to use more non-FCRA funds for administrative expenditure, if that is possible. If that is already, some non-FCRA funds are available. For example, some local funds are available. There is some interest that is coming up there. Currently, that interest is used for some good program. Try to channel that interest to admin, and FC money, you can use it for the program. Just a possibility. This is not the only possibility, one of the possibilities, if it is possible in the reality of that organization. Secondly, raise local funds for admin expenditure instead of using foreign funds. If there is already a fundraising effort, try to explain to the donors that, we need some local funds for the meeting of the admin cost. I know it is not easy to get a donation for admin cost. Nobody wants to donate for admin cost. People are interested to donate for costs such as children's cause or to serve the vulnerable people in the society, but not just for admin cost. Reduce admin cost of the by NPOs. This is a good effort. Lot of NPOs end up spending quite a bit on the admin. It is very important they make an effort. I think in this perspective, this is a welcome amendment. In the perspective of cost reduction, particularly admin cost reduction, it is a very welcome amendment. And applying for prior approval to spend over 20%. This is just to keep it open. There is a possibility that if you want to exceed 20%, you can go for approval. But people like myself will not recommend this, because already it is 20%. And if you want to increase to 30% or 40%, that's not a good idea. However, in a particular reality, there is FC money has to be spent only for admin, because there is a lot of programs going on with local funds. Then that can be explained to the FCRA department with the proof, and possibly obtain the approval for extra admin expenditure over and above 20%. Now, I would like to go to the third one. Of the three most important, first one is prohibition of intertrust FCRA funds. Second one is the restriction on the admin percentage, 50 to 20. Third one is the bank account. What is happening to the bank account? Now, FCRA designated bank account has to be with State Bank of India, New Delhi, main branch, what they call in short NDMB, the New Delhi main branch. And that is there in section 12 and 17. Now, to give a little explanation on that, currently an NPO is authorized to keep their FCRA designated account in any of the PFMS compliant bank. As you are all aware, public financial management system compliant banks are so many. And public financial management compliance system is the PFMS is by the central government. As you may be already aware, the government grants go through this PFMS. So banks were added to the PFMS system one after another. In fact, 2 years back, when the FCRA brought up a regulation or an instruction that all designated bank accounts should be PFMS, many bank accounts, many banks, including the prominent banks, why? Including some of the nationalized banks, were not PFMS compliant. But slowly they all became PFMS compliant. So NPOs are having their designated FCRA bank account in any PFMS compliant bank that they are comfortable with. But now they cannot do that. They have to open the designated bank account in the SBI branch in New Delhi. There is a separate FCRA section now in, excuse me, there is a separate FCRA section now in the SBI New Delhi for the FCRA account. So, but fortunately, after opening that account, NPO can have its own utilization account. And for that, they are allowing the current designated account in whichever bank they are having can be used as a designated account. Not only that, if the NPO wants to open more utilization account, they can definitely open more utilization account and they can transfer. In practical reality, not all NPOs are able to manage with one utilization account. I come across several NPOs with the national level implementation of programs. They have to have 10 utilization, 25 utilization. I have an example of almost an NPO having 250 utilization bank accounts. So in reality, if they have to do all that, they can do that. One question that has come up is, can the money from the designated bank account in SBI, NDMB can be transferred to any of the utilization bank account or to the single utilization bank account, and from there only it has to go to all utilization bank account? If you see the public notice dated 13th of October, it doesn't prohibit money from the designated bank account, that is NDMB, going either to the first designated bank, first utilization bank or any other utilization bank. This is number one. Number two, another question that is going on, if you are now given time, NPO is given time to open this NDMB account on or before 31st of March 2021. Now, if an NGO opens an account anytime from now, let us say, for example, December, then from 1st December onwards, the NGO has to route the money only in the NDMB account and not in the previous account. Now, after opening the NDMB account, if there is some balance in the old account, what should happen? There is no mention in the public circular, public notice, what has to happen. My understanding is that need not again go to the NDMB account, because the idea of the central government is to control the inflow. And already the old money has come into the country through the existing designated bank account. Then where is the question of again routing that to the NDMB? In NDMB, whatever new transfers from the date of opening the NDMB, I suppose has to go through the NDMB. There is no clarity. I suggest that in case you keep your eyes and ears open, let us keep our eyes and ears open. In the in the FCRA portal, time and again they are putting public notice saying this is a new notice, so we can look up and see whether they come up with any particular instruction on that. Having talked about designated bank account, I would like to go to 30 seconds, not more than that, to public servants. Government has come across certain specific persons in public servants category where there is lot of litigation going on. Therefore, they have added the public servant in the prohibition category. If you Google, you will already know who are these persons who are having litigations, and now their litigations have no value because the act is amended. Inquiry during FCRA renewal process. You may be already familiar, during the registration process, a lot of inquiries are happening. They go to each trustee, they go to the field of the NPO, and they even inquire certain other people, and they make a report. The IB, local IB, Intelligence Bureau person makes a report. So far, for the renewal, there was no such requirement. For example, the first renewal of all the NPOs registration, FCRA registration took place in the year 2016. There was no big inquiry, although some NPOs were very much inquired because of certain special reasons or complaints, etc. But now all NPOs who are going to apply for renewal, they will be subject to this inquiry. The next renewal is coming up in 2021. See, the renewal itself was brought in the statute only by the new FCRA Act 2010. In the original FCRA 1976, there was no provision for renewal. Was supposed to be a permanent registration. In fact, if you go way back, the history, 1967, the original first FCRA bill came, and 1976, the first act was enacted. 76 to 84, there was no registration or no prayer permission. 85, 1st January onwards, the registration and prayer permission became mandatory. And in 2010 law, the new provision for renewal was brought. Now, first renewal of all those old registrations took place in 2016. Out of 43,000 registered NPOs, 23,000 of them did not get their FCRA renewal. Finally, there were only about 20,000 plus FCRAs were registered. They were renewed and they were going on. Now, the next renewal is coming up in 2021, next year. So, all the more the reason why NPOs have to be vigilant and comply with all the provisions, including the amended provisions of the FCRA 2020. Going further, the Aadhaar, copy of passport, OCI, board members, this is now becoming a norm in the country. As you know, everywhere we have to give the Aadhaar, everywhere we have to give the PAN, including in ITR 7 that we are going to speak about very soon. Now, what is the purpose behind this? If you look at the purpose behind this, FCRA will easily come to know a single person is in the board of how many NPOs. Sometimes you will find a person is in 25 NPOs, 30 NPOs, 60 NPOs. Of course, I don't mean there is any malafide intention. For example, if you take certain religious bodies, you will see the head of the religious body will be the president or chairperson of the various entities registered in that religious category. So this is not a malafide act. This is not something to hoodwink anybody or something to manipulate anybody. That is their governance system. However, government wants to see that how many entities a person is there. It is easy to see now. Similarly, passports they want to mention because the foreigners are not welcome in the FCRA bodies. As you are well aware, the FAQ of the FCRA says that the foreigners cannot be there unless, again, somebody is married to a foreigner. You cannot marry only for getting FCRA number. OCI cards, again, overseas citizen of India, if they are here in the NPO boards, and that is also going to be visible. These are new requirements. I see a lot of problem because there are so many NPOs in the rural areas. Ordinary, simple people, sometimes even illiterate people. For example, if you take the self-help groups who also have some NGOs registered for them, they may be illiterate, but they are wonderful people, tremendous people, because they are involved in important programs. Now, if you ask them for Aadhaar card and OCI card, அவங்க எங்க போவாங்கன்னு தெரியல, எப்படி போய் என்ன செய்ய போறாங்கன்னு தெரியல. So there is going to be a serious problem for these smaller ones. Bigger ones, of course, they don't have problems. Additional requirements for prayer permission. Here, very simple. So far, if a registered body is suspended, then the suspended body, you have such bodies all over the country, including in Madurai and down south. If an NPO is suspended, they cannot spend the money. They can only spend 25% of the available money, and that too after getting permission. Similarly, they cannot get a new money. They cannot send back the money. Nothing they can do. All that is for a registered body. FCRA registered body. All those provisions are now copy pasted for also a prayer permission body. Prayer permission is only a temporary permission. Even for that, they have brought this regulation. If during the prayer permission, which is sometimes 1 year, sometimes 2 years, very rarely 3 years, if there is any report from the grassroots level, that is from the IB, and if they find there are irregularities, they will use the same provisions that they are using for the registered body. Suspend it, and during the suspension, all those conditions restrictions will apply. Now, extending the suspension period. Government found that 180 days also not enough for them for investigation. Nowadays, no investigation, you never know when it starts, when it ends, how it goes. Therefore, they have reserved another 180 days, now 360 days for the investigation period. Now, after that period, two things can happen. One is that it will go for cancellation, from suspension to cancellation, and another is that the suspension will be revoked and it will get re-registered again. Voluntary surrender of FCRA registration. This is interesting. I myself have come across quite a few asking, sir, we don't want this FCRA anymore. We want to surrender it. And I used to find there was no provision for surrendering. This is like, you can now think of the Tata 12A case. Tata 12A, they wanted to surrender voluntarily, as you all know. But the income tax department, so there is no voluntary surrender for the 12A. We know when to cancel it. And department took liberty time to cancel after the accreted income tax provisions came into the statute, 115 TD and so on and so forth. Whereas in FCRA, similar situation was there. So far, there was no such possibility to surrender. Now, the provision for surrender has come with a important danger. That is, when the FCRA number has to be surrendered, all assets acquired out of FCRA also has to be surrendered. Now, 2-3 questions. Number one, sir, we don't want to surrender with this condition. But what will happen if you don't renew it? No clarity. No clarity. If you don't renew it, will you be considered as surrendered or will you be considered as cancelled? No idea. This can happen also for a 12A 80G, 12A renewal. 12A renewal, as you know, is postponed from June to October to March, April now. So if somebody doesn't want to renew the 12A, what can happen? So complex questions are before the non-profit organizations. Now I go quickly to the Tamil Nadu Public Trust Bill. Since it's only a bill, I do not want to take too much time. Also, there is no experience of implementing this legislation. So I cannot talk with any experience-based knowledge, which I can speak such a lot for the FCRA or income tax. However, I'm aware of other states such as Maharashtra, Bombay Public Trust Act, which came into statute as far back about 70 years back, 1950. 1950, the Bombay Public Trust Act came into the statute, and even undivided Gujarat is now having the same act. At that time, both were together. So there are so many experiences I come across in the Bombay Public Trust Act. I hope, I wish that all those experiences are not going to be relevant here, because some of those experiences are not that healthy or that good. However, I thought of just running through the bill's salient features that are there before us. For example, number one more registration. இப்போ நம்ம சர்டிஃபிகேட் வாங்கினோம்னா எங்கே வைக்கிறதுனே தெரியாது. எத்தனை நம்பரு, எங்கே வச்சுக்கிறது அப்படின்னே தெரியாது. ரெஜிஸ்ட்ரேஷன் ஆஃப்டர் ரெஜிஸ்ட்ரேஷன், incorporation registration to FCRA registration, income tax registration, GST registration, EPF, ESI, go on and on and on. Now one more now, registration under the Public Trust Act. Inquiry for registration. இருக்கிறதெல்லாம் போதில் நிறைய என்கொயரி இருக்குது ஆல்ரெடி. இன்கம் டேக்ஸ் என்கொயரி, FCRA என்கொயரி, GST. Now one more inquiry for registration. Changes in public trust. This is serious. If there is any change, the government will come into picture. Change of objectives, it will come into picture. Change of trustees, it will come into picture. If the change of trustees is not intimated, it will come into picture. And similarly, another interesting aspect, or not so interesting for NPOs and trust, the collector has to be informed about the trust property. What are the properties available in the trust, owned by the trust? Questions will come: who is owning the property? Trustees or trust? How? What is the ownership, etc. And of course, if there is no title at all and trust is happily using it, what will happen to the information about the property is another question. Disqualification of trustees is another aspect that is coming up. Power of the registrar to issue directions is yet another dangerous, quite a dangerous aspect. Investment in public trust money, I don't think this is a big issue, because already there are enough provisions. Under the Societies Act, there is provision. Under the Income Tax Act, there is provision. By the way, the society also will be covered by the Trust Act. The Trust Act is not just for trust, it will also cover all the existing societies. People have been asking me, what, sir, the title is Trust Act and you are saying society will cover? Yes, if you go to the definition of trust in the Trust Act or in this bill, it also covers societies. So, and that is the case also in Maharashtra. In Maharashtra, though it is called Bombay Public Trust Act or Maharashtra Public Trust Act, today all the societies are also covered under the same Charities Act. Previous sanction of the registrar is required for sale and lease of the property. So far, we have been debating about whether we need to go to the Commissioner of Income Tax exemptions for getting permission for alienation of the property by way of lease or sale. Now there is one more from the Registrar of Trust that we have to get the previous sanction. Of course, in the case of trust, current provision is you have to go to the court of law under the CPC to get a permission to alienate the property. Auditors and their duties. I don't know if you have already come across, auditors are asked to do much more than auditing. Auditors are asked to keep the registers and also send reports directly to the registrar. I heard that I confirmed that SIRC has already submitted a representation to the law secretary, allow us to do our work and not the trustees' work or the trust work. Such a representation is already in the files of the law secretary. Budget for the trust. Now that is becoming compulsory. That is also the case in the Bombay Public Trust Act. Grant of certified copies, power of the registrar, filling of vacancies. Filling of vacancies of trustees is trustees' business, but the government is taking that now. Other miscellaneous. We look into each of this a little more in detail, but very quickly. Application should mention the following: the origin, nature, object of the trust, principal, office or place of business, name of and address of the working trustees. There is no definition for working trustees, but we have to give the list of the working trustees. And then any person having interest in a public trust or the registrar can make on his motion, registrar give a public notice to the enquiry. That will be about the enquiry by the registrar. There are enough disputes going on, as you may be aware already. Such a lot of disputes are already going on within the non-profit sector, particularly in the trust, because of factions and because of misunderstanding among the families. And there is a big common trust that is running several institutions. You may be already well aware of this. Now, this is going to be very easy for the registrar. The registrar will find it very easy now because we are only going to give the complaints into his hands. Information to collector about the trust property, where the part of the trust property of a public trust is situated, limits of the particular district, we will have to inform the district collector. This is another important one, disqualification for trustees. The other ones are understandable, convicted and less than a particular year, and undischarged, insolvent, unsound, etc. But look at this. If he is not a citizen of India, now there are a lot of people from our own state, Tamil Nadu, who are settled in other countries, particularly in North America, more particularly in the United States. Of course, whether you will now call it United States or divided states of America, that you have to see. However, there are many of the children who have become local citizens in that country. Now, they are all trustees in the trust that are running here in Tamil Nadu. You may be familiar, quite a few such trusts are there. And those people, though they are settled there, they have a kind of a heart to the poor or the deserving people in Tamil Nadu, and they are sending their funds or they are operating their trust here to give some service regarding education, regarding medical health. I am personally aware of quite a few such trusts. Unfortunately, they are not now eligible. So there is a request from several such people to give a representation. To give a representation, at least to allow the PIOs, person of Indian origin. They may have obtained a local passport, but they are originally from here and they are holding a PIO. So there is such a kind of a request that is happening. Hopefully something better can happen. It is understandable that completely, nothing to do, a person who has nothing to do with the state or the country, or if there is some undesirable person, then he is disqualified from becoming a trustee. But when there are persons who are passionately serving good causes in the state, if they are disqualified, that may become quite difficult, not good for the society. And then, of course, power of the registrar to issue direction. The registrar from time to time issue directions to any trustee of a public trust or any person connected therewith. Now, you never know for what he can issue direction. If there are some misunderstanding between the registrar and the trust, for whatever reason, we can think of so many reasons, they can easily be issued with a notice, and that can become a problem. Investment of public trust, I don't want to waste time here because we are already following, no, if they are exempted for income tax, then they are already following section 11.5, and the investments will be well within the section 11.5 mode. This is another problem. Previous sanction of the registrar in case of sale or property belonging to a public trust, subject to the directions, the instrument of trust, etc. No sale or mortgage or exchange or gift of any immovable property, no lease for a period or not exceeding 5 years in the case of agricultural, and 3 years in the case of non-agricultural building can happen without the previous sanction of the registrar. This is the most debated topic in the states of Maharashtra and Gujarat. As you are aware, the real estate cost, of course, after Corona, it may be slightly different, but the real estate is the most precious asset in many cases. In the case of many trusts, even in south of Tamil Nadu or even in Chennai, for example, there are prime lands owned by the non-profit organizations, and particularly many of them are trusts, and of course also societies. So this is the million-dollar question: how this can be this can happen in a smooth manner without running into problems. In Maharashtra, for example, it takes sometimes not months, years to get permission from the registrar of what is called the charity commissioner. In Maharashtra, they are not called registrar, but they are called the charity commissioner and the charity commissioner's office. Auditor's duties. It shall be the duty of every auditor auditing the accounts of the public trust to forward a copy of the balance sheet and income expenditure to the registrar, within whose jurisdiction a public trust has been registered. As auditors, it is understandable that we certify accounts, we certify report, but we are not supposed to be forwarding them. But here the law says we should be forwarding the reports to the registrar. Budget, it is a welcome requirement. I mean, every non-profit trying to make a financial planning is not a bad idea. Therefore, such a provision is welcome. Power of the registrar. Power of the registrar is to inspect the property within 48 hours of the notice, to call for or inspect any proceedings of the trustees of a public trust or any books of accounts in possession of the possession or control of the trustees. The question is, in the case of trust, unlike in the case of company or perhaps even a society, the maintenance of minutes books is a big question. Many small trusts, particularly run by family people, not as private trusts, but as public trusts running schools or running other educational institutions, the minutes books may not be in great order like it is in the case of a company. Therefore, if there is inspection and if the minutes books are not in order, that is going to be an issue. Then the power of the registrar, if the auditor's report has showing material defects, then the registrar may require working trustee to submit an explanation. Filling of vacancies, this is quite a serious proposal. If any vacancy occurs, then working trustee should inform the registrar. Registrar can issue direction regarding filling of such vacancy, and the working trustee shall comply with any such direction. Think of it. In the Income Tax Act, to my memory, as far back in the late 80s, there was a provision, some of you may recollect, that governing body members will be appointed by the Income Tax Department. There was an uproar in the country. Many represented. And as you know, the politicians also have so many of these bodies. And finally, it was given up. Now, FCRA doesn't have such a provision, even in the amended provision, to appoint trustees. Now, the Public Trust Act is bringing out a provision that the registrar can fill the vacancy, and the registrar can give direction to fill the vacancy. You can imagine. Of course, independent director in the case of a company is a different concept. Special officer in the case of a cooperative is a different context. Special officer in the case of a society of the Tamil Nadu, registered Tamil Nadu Societies Act, also different context. Now, trustees coming up, trustees appointed by the registrar is going to be another important reality. How far this can be smooth is a question. If look at it, if a working trustee fails to give such information, if a working trustee fails to give such information to fill the vacancy within the time specified by him or comply the order of the registrar may by order pass and fill the vacancy. So if there is a failure in filling the vacancy on the part of the working trustee, the registrar can fill the vacancy. This can again become serious. Sometimes the failure, there may not be real failure, but failure will be established by those who wanted to bring some new trustees. Other miscellaneous. This is, of course, the inquiries officers inquiring will have the power of a civil court, and the proceedings will be in the nature of judicial proceedings. These are the salient features of this Tamil Nadu Public Trust Bill. There are quite a few have given representation. To my knowledge, our own institute has given representation, but we cannot, I understand, when I was talking to our officers in the SIRC and telling them there are quite a few sweeping provisions, they were expressing, sir, in relation to auditing responsibility, we can give representation, sir. If there are issues that are affecting the trustees directly, I am not sure whether we can take up or they have to take it up. I think there is a point. Those who are affected people, those trust, for example, having children who are foreign citizens, but they are trustees of this trust, they should be able to represent in relation to the disqualification. So there are representations happening, and I also would like to appeal to our own members. If there are some issues that are going to be very tricky, it is a high time to make a representation, or at least to facilitate or assist people who are really affected, so that finally when the law comes, it is a law that serves a purpose. It is a law that serves the purpose for which it is brought, and not affecting other people. Very often, for the people whom it is brought, they escape, they go to another level, but others get caught in the law. I hope such a situation will not happen in this case. Having said this, I have only very, very short time now. I think, Chairperson, can I take another half an hour for the third part? Am I audible? Can you hear me? Hello?
Sir, please go ahead, sir. We have up to 8 now, sir.
Okay. No,
Yes.
there may be people who may want to ask questions now.
Yes, sir. Last 15 minutes we can have it now, sir.
Okay. So may I go ahead with the third part now?
Please, sir.
Okay. All right. Now I want to make a statement that non-members at Madurai branch, you are already much better off with income tax and non-profit organizations. I am saying this not to praise any of you, because I have personal knowledge of several of you assisting non-profits so very well for last so many years. And also, in addition to that, you have beautiful knowledge sharing happening there all the time. As I just mentioned, on the 21st September, In the SIRC, we had so many who have joined, and we could only answer only half of the questions. And of course, on October 7th, when Dani was sharing a beautiful presentation, very comprehensive presentation, which I have the opportunity to look at, I saw that what we have been learning together for last so many years was beautifully shared. And in addition to that, I am wondering now what I will be doing now. I'm making a humble attempt not to duplicate, not to repeat, but to complement and supplement. I hope I'm going to do that. So what I would like to do is this: three things. Overview of the various exemptions of 10 and 11, not what you have already heard such a lot so very well, but the adding value to that, supplementing to that. Second, in ITR 7, what are the schedules and what schedule should be used for what exemption? This is a big question because this ITR 7, I don't know how to describe it. There are other forms which are clear: salary person, company, partnership, etc. But ITR 7 is like a residuary form. Anybody can file. Those who are covered under section 139 4A can file, 139 4C can file. Understandable, because they are all obliged to file. But those who are not at all obliged to file, when they have to file, they are asked to file. This is the form that they have to use. So you will find number of bodies who have nothing to do with Income Tax Act. They are also filing the return through this form. So lot of complexity. I think complexity is a very positive word. Putting it another way, lot of misunderstanding or a lot of problems are happening with the ITR 7. It is not out of place to share with you. In my interactions with the department, in the past a few times, I spent more than 2 sessions only running through the special aspects of this form with the officials of the department from southern states, more than 2 times. So we ourselves go on filing this ITR 7, including this year. We have filed a number of returns with the latest form ITR 7. So one issue is what schedule has to be used for which exemption. For example, 11 exemption, what are the schedules to be used? If you use a wrong schedule, you are running into problem. And if you use for the right section, wrong schedule is a problem. And for a wrong section, right schedule, if you use, also problem. So I would like to focus on that. And then cautions to be taken while filling and uploading the ITR 7. Talking about ITR 7 is like talking about one leaf in a branch of a tree belonging to a forest. Now, what is forest? Income tax exemption and non-profit is a forest by itself. Now, if you add other laws such as FCRA and then the Public Trust Act and then the so many other acts, it is a forest of forest. In the forest of forest, in one forest, in one tree, one branch, one leaf, that is ITR 7. It is on that I am going to share. I hope you don't mistake, because if we make a mistake here, finally it reflects on the assessment. And as you are aware now, it is going to be faceless assessment. So what you fill here is going to make all the difference. And that is why I am taking liberty to focus on this. Overview of the various exemptions of 10 and 11 and filling appropriate schedules in form number ITR 7. Look at this. Number 1. If we claim exemption for a trust under section 11 with the 12A or 1023C 4, 5, 6 and 6A, then we have to use these schedules. Schedule VC for voluntary contribution, AI for the income, ER for the revenue application, and EC for the capital application. Similarly, if the assessee is claiming not 11 or 1023C, those categories you see in serial number 1, If you claim other exemptions, such as 1021 for research bodies, and if you go to various others, B, triple A, 1023B, FB, etc., they are all relating to entities whose income is unconditionally exempt under various clauses of Section 10. Unconditionally. What do you mean unconditionally? In Danish session on the 7th of October, you would have gone through a conditional exemption. That is a term that we were using for the last 30 years. It is not in the Act. We used to simply call it total exemption without condition and conditional exemption with condition. I think you have seen Danny giving some 6 or 7 conditions, starting with, isn't it, Danny? 12A and application of 85%, investment, accumulation, filing return, etc. None of those conditions are applicable to these bodies in serial number 2, but they also have to file using ITR 7. So for them, the schedule applicable is IE1. And similarly, assessees claiming exemption under 1023A and 1024, like the what's called the trade union, etc., it will be schedule IE2. And then moving to number 4, serial number 4, there are 2 categories, very interesting categories. One is 1023 3AB, 3AC. As you know well, these are the category where the educational institution or the medical institution is substantially financed by the government. So they have to use certain schedules, IE3 and BC for government grant. And then number 5, 1023 AD and AE. This is a category where the education and the medical body is going to use file the return claiming exemption. Now, 4 and 5 serial number, that is 1023C 3AB and 3AC, for with substantial government grant. Again, substantial government grant was under lot of dispute for a long time after the introduction of Rule 2BBB. Now it is clear that the government grant has to be over and above 50%. In that case, there is no need for going for any special approval to the Commissioner of Income Tax exemption. Similarly, if the educational or the medical bodies gross receipts are below 1 crore, they also don't have to go to the Commissioner of Income Tax for approval. So those 2 categories, they have to fill these schedules, Schedule IE3 and Schedule IE4. In the Schedule IE3 for the 4th category, Schedule IE4 for the 5th category. Now, I come across very interesting scenarios. There is one of our members who brought to me an interesting scenario, that is, if an institution is having both government grant and also self-financed fee collected. Now, if the government grant is not included in the accounts, then the turnover or gross receipts is below 1 crore. If it is below 1 crore, it will fall under serial number 5, and automatically there will be exemption provided other conditions are satisfied. There is no need to go for approval to the Commissioner of Income Tax exemption. Unfortunately, the government grant is a income now. If you go to section 224, which speaks about income, from 2018, government grant is a income. It is defined. Now, people never used to take government grant in the aided schools and colleges because the government sends the salaries directly to the staff, the faculty. That is for another reason. The reason, I'm sure you are knowing well, that some institutions were not paying the full salary after receiving the salary grant in the institution. That's why government decided to send the salary directly to the staff. Now, taking that as a kind of an excuse, some institutions were not showing the government grant as an income in the institution. Now, if you take that income, in the case that the member brought, what happens? The total turnover is such a mix that it is above 1 crore and also the government grant is below 50%. You understand where it stands now? Both under serial number 4 and serial number 5, it is not eligible for total exemption. So it goes to, then it requires then commissioner's approval. Then it will go to 1023C, 6 and 6A. So it is very important that we take care of this aspect. Nowadays, most institutions, neither they are fully government with the government grant, nor they are fully self-financed. So-called government-supported institutions are becoming now partly government-supported and partly self-supported. Self-support portion is increasing year after year because the government grant is decreasing year after year. So this is an area. In these two cases, if you ask me what would be my advice, I would say better to have 12A in place. If 12A is in place, then you can go for the 11 exemption. But you heard from Danny on the 7th of October, from the implementation of the Finance Act 2020 from 1st April 2021, you have to choose only one, either 12AB or 1023C. You cannot have both the options open. There was a beautiful judgment in the Bar Council of Maharashtra in the Supreme Court years back, which categorically gave an option to the assessee. Choose your option. Both are available for you. You choose 12A and 11B, read with 11, or you choose 1023C is your option. Assessee's option. Department should not sit in judgment. But that is gone now by the introduction of the 12AB through the Finance Act 2020. So it is really a very important area to be careful. Political party, I have the experience of auditing some parties. I don't think it is a big issue to have exemption for them. So I don't think I should waste your time. Electoral trust claiming exemption, again, is quite related. They are cousins with each other. So I move on to little more details on these two. That is, on the first one, second, and then fourth and fifth, I go to some details with your permission. Number one, schedules of ITR 7 utility required to be filled mandatorily for trust and institutions claiming exemption under this category. Section 11, one category with 12A or 12AA, and then section 1023(4). 4 and 5 are 4 is for general charitable institutions having all India importance. 5 is charitable and religious having all India importance. 1023(6) is above 1 crore for education. 1023(6)A is above 1 crore for medical. So for these categories, registration or approval is required either under 12A or 12AA, and fill the details in the details of registration under the Income Tax Act in Part A General. Return filing of section 1, filing is under the section 139 4 capital A. In other words, it is a mandatory requirement. As you are aware, this section 11 was always mandatory to file return. But 1023C, 4, 5, 6 and all, some time back, it was not mandatory. Now, of course, it is very much mandatory. For that matter, even this AB, AC, AD and AE, for a long time, it was not mandatory. They are automatically exempt, unconditional. But now, one condition is they have to file the returns. That is mandatory. Now, other offer the contributions and income in schedule VC and AI. VC is, as you know, voluntary contribution, and AI is the total income. Now, amount applied for charitable purpose, ER and EC. ER is for the schedule, ER is for revenue expenditure, and schedule EC is for the capital expenditure. Assessee claiming exemption through deemed application required to fill the details in point number 4 of the schedule part B TI, and has to furnish form number 9 capital A. Assessee claiming similarly form 10 has to put it in the point number 4(6) of the schedule part B TI. Why am I so particular about this point number 4, 4 and 4(6)? After filing form 9A and 9, in the past, there was no 9A at all. 9A came only about 4 years back. Of course, 10 has been there for a long time. Now, both the forms are in place. And after filing these two forms, we normally don't file both the forms. We only file either 9A or 10.
9A is when there is a small surplus that we can spend it, that the NPO can spend it within 1 year. 10 is a large surplus that the NPO cannot spend it in 1 year, but has to go for 5 years. Now it is 5 year. Previously it was 10 years. Now that is made half. Now it is only allowed only for 5 years. After doing it, we have to fill in the right place. 4.6 of the Part B TI for 10 and 4.4 of the Part B TI for 9A. Otherwise, in the faceless assessment, we may not have face. Assessment will be different. Any other taxable income is required to offer in house property, business and profession, capital gains and other sources. Non-compliance of 11 and 12 are ineligible to claim exemption is required to fill schedule number 5. What is non-compliance and ineligible schedule serial number 5 of the schedule BTI? They are, if we have not deducted tax at source, that 30% disallowance, if there are cash payments that are under the mischief of 40A3 and 40A3 capital A, if they are there, they will be filled up under this serial number 5. And of course, audit report is required to be furnished in form number 10B along with the return of income. I know that you discussed this in detail in your session on the October 7th, because many ITR 7s were filed without form number 10B. As Danny cautioned, I think on that day, in the past it was possible to file ITR 7 without filling filing date of form 10B and form 9A. Now we cannot do that. Now in the ITR utility, whether you use Java utility or Excel utility, there is a place, a field where we have to mention whether we have filed the 9A or 10. If not, we have to say no, and whether we have filed form 10B, and we have to also mention the date of the filing of the 10B. Now, for the past 3 years, as you have already heard in the beautiful session on 7th of October, you have the circular. The circular says that the commissioner has the authority or discretion to condone the delay and accept the form number 10B, not only form number 10B, also form 10 and 9A, everything, and also ITR 7. Moving to the 1023, 4, 5, 6 and 6A, again here, since it is above 1 crore, not under the 3A or 3AC or 3AE, here we have to have the approval of the Commissioner of Income Tax exemption. And the return filing is not under 4 capital A, this is under 4 capital C. And other contributions and income and contributions have to go to schedule VC. அதாவது இந்த இடத்துல நான் போடல, ஆக்சுவலா விசில போகணும், ஓஎஸ்ல போகக்கூடாது. நிறைய பேர் தெரியாத it even happened in our own office. விசிக்கு பதிலா ஓஎஸ்ல போட்டாங்க. If you put it in OS, it gets taxable. So though it may be in the nature of other income, when you go out of ITR 7 to AOPs and others, here it has to be clear that contribution and income has to be put under the voluntary contribution and not under the schedule OS, which is for taxable other income. Now, amount applied for charitable purpose, same thing here, just like 11, ER and EC, revenue and capital has to be filled up. Assessee is claiming exemption through deemed applications required to fill 4.4 and 4.6 as the case may be. And any other taxable income will be brought under these categories of house property and business and profession and capital gains and other sources. Non-compliance of section 11 or 12 or ineligible to claim exemption is required. It is not 11 or 12. You will find in the government utility itself, you will find it like this, non-compliance of 11 and 12. It is here non-compliance of 1023C, 4, 5, 6A and not 11 and 12. And as you know, the audit report won't be 10B, it will be 10BB. When an assessee claims total exemption, so-called total exemption, now the 10 exemption under section 10, it will be 10BB, not 10. Just to not to go into the nuances, but just to give you a glimpse, where we have to be careful. We see voluntary contribution to be mandatorily filled by all persons filing ITR 7. So this is the place, and here you can see 4 portions: A, B, C, D. A is speaking about local funds, B is speaking about foreign contribution, and C is total contribution, and D is anonymous donations included under 100 and according to 115 BBC. Now, local contribution. See, if you take typically a financial statement of a non-profit organization, you will have a separate financial statement for the foreign contribution. And in that foreign contribution financial statement, you will find if there is a corpus that will be there separately, should be there separately, and other than corpus should be there separately. So that has to be filled up. And when you are filling up the foreign contribution, it should not be including the interest and all that. It should be actual contribution that is coming from outside the country. Now, it will be easy to say New Delhi NDMB, that is SBI NDMB. The money coming through that account only has to be coming into this place, either as a corpus if it is a corpus, or under the other non-corpus. And many non-profits have separate financial statements for local funds. They not only have receipts and payment, they also have income and expenditure, they also have a balance sheet. Therefore, I also recommend strongly that for local funds also, it is better to have separate financial statement, including a balance sheet, though many are not maintaining. They are just satisfied with RNP, and they combine RNP of FCRA, RNP of local, and make a combined balance sheet. Of course, they make a balance sheet for FCRA because that is mandatory to be submitted along with the annual return in form number FC4. Now, coming to the D, as you know well, that is the hit by the 115 BBC. You come across some problems here. Some ITR 7 I have come across is not clearly putting the corpus donation and the non-corpus. In the past, it has caused a lot of issues, and many have received queries from the CPC. Other one is the AI, aggregate income derived from the derived in the previous year, excluding the VC, excluding the voluntary contribution, which is going separately. So receipts from main objects, receipts from incidental objects, rent, commission, dividend income, interest income, agricultural income, net consideration or transfer of capital asset, any other income, etc., and pass-through income, etc., all total together, add rows, and this is the aggregate income. All the income other than the voluntary contribution has to be filled up here. Now, one has to be careful what is main object and what is incidental object. If there is no incidental object at all, if there is no activity in the nature of incidental at all, then you cannot fill up anything under 2, because there is no such activity, no income. I come across sometimes the income is just bifurcated, certain portions in the main object and certain portions in the incidental. That will create a lot of problem, particularly after the amendment of section 215, the provisos to section 215, which is speaking about activities in the nature of business. Now the department is finding it not easy to differentiate between incidental and the activities in the nature of business, trade, or commerce. One more thing, agricultural income. It is a situation where under the section 10, the agricultural income is exempt, but not for the purpose of application. Previously, there was a possibility. Now the act is amended in such a way. In section 10, what is exempted will be either it is 1023C or under 11, not the other exemptions. Like because agricultural income is exempted, it does not mean it need not be applied. It has to be applied. And similarly, revenue. I don't want to waste your time here, but something very important here is the establishment expenditure or the admin expenditure is most important under A. And then after that, we go to the objects. If you see B, objects B. This category is not at all there in the earlier years. It's only last year in the ITR 7, this categorization between establishment and the activity expenditure, object related expenditure is brought in. I must thank several of the members because especially from members from Madurai branch, we all gave lot of representation to the commissioner exemption that also went to the CBDT. I don't claim that only because of our representation. There must have been other people in the country who would have given representation. This is a beautiful analysis between classification of expenditure of a non-profit, between admin and program. This is what we spoke in the FCRA for a long time. In FCRA also they are speaking about particular percentage and the category also, what is administration and what is not administration. I must mention to you here, without going to names, department is aggressively picking up and taxing non-profits which are found to be having high admin cost, saying that the charity is minimal and admin cost is huge, therefore you are not entitled for charitable exemption under section 11. So this is an area to be careful. Moving further, schedule EC is the capital. Again here there is a good detail. Addition to capital work in progress, acquisition of capital asset, cost of new asset for claiming exemption under section 11(1)(a) restricted to the net consideration and other capital expenditure. Beautiful, the sections in 11 215 to 13 is beautifully brought in the form now. Previously there was no such clarity. Of course, one should have the clarity of 215 to 13, which is vast. Though the number of sections are small, the knowledge that is available, the experience that is there, the complexity that is there is such a lot. It is ocean. Now, most of that is also picked up here in the ITR 7. In other words, if somebody wants to do a doctoral program, ITR 7 is the best project to start a doctoral program. One doctoral program won't be enough. We can take each schedule and take one doctoral program. Interestingly, work in progress has to be put separately. Like I have coming across number of buildings which are halfway, 3/4 not completed. So that we bring it here. If you don't bring it here and show it as application next year, you may not have that much income, but you will have a big asset capital application. And then the question will come whether the excess expenditure can be brought forward, taken forward or not. I'm sure you heard on the 7th that there is the Supreme Court decision, the Supros Society, which the Supreme Court allows carry forward, though there is no specific section like 70, 71, etc. In the case of business income, here there is no specific section, specific provision, but the Honorable Supreme Court has allowed the carry forward. But that is again a waste of time. You can claim the work in progress itself, and whenever it gets completed, the remaining portion will get added here. And then acquisition of capital asset. See, the third one is interesting again, new asset 11(1)(a). You are all aware that when there is a capital gains of, let us say, 10 crore and the NPO is able to invest in the fixed deposit 9 crore and 50 lakhs, and the 50 lakhs is expenditure or whatever. So that fixed deposit becomes the new asset. And as you heard in your earlier seminar, if the fixed deposit is there for 6 months or more, then it is already considered to be a new asset for the purpose of capital gains exemption. So that is also provided here. You can put it here. Nowadays, you come across quite a few non-profits selling this or that. Sometimes they are selling some computers, old computers. Sometimes they are selling some furniture. Sometimes they are selling their land. And the question will be how to fill this form. You can fill this form to the extent of the fixed deposit available. Now, that does not mean you are prevented from accumulating as per section 11(2). Many people, they don't satisfy themselves, or they don't stop by only showing here. They also go for accumulation under section 11(2) to be on the safer side. So these are some of the things in the EC. And then, of course, then you go to the TI, the statement of the total income. Again, beautifully picked up. The form picks up the voluntary contributions from the VC, and then the aggregate, it picks up from the AI, and then it goes for application of income serial number 4. And in serial number 4, it goes to the application of religious purpose or charitable purpose. Then it goes on to say amount applied during the previous year, revenue, capital, amount applied during the previous year, repayment of loan. See, another interesting thing. So many trusts have suffered a lot. When they went for a huge loan of 10 crore, 50 crore, 100 crore, 200 crore, today you have trust borrowing up to 500 crores, if not more. Now, the year in which they borrow the money, they don't have income because they are just starting setting up the institution. After 2 or 3 years, when the classes are starting, the fees income are coming, the capital expenditure is not there because it has been over in the previous years. Fortunately, now the matter is settled. You can happily claim the repayment of loan as and when the income is generated. There is a relationship between repayment of loan and the income generation. When we submit proposal to the bank, we show that we are getting so much income in so and so year, third year after the commencement or fourth year after the commencement of the project, and that year the repayment will happen. Therefore, repayment can be shown as the application of income, and that makes life of the non-profit and even us little better. Of course, we can go on and on, but that's not my idea. If you go to additions, for example, again you can see corpus donation to other trust or institution, chargeable as per explanation 2 to 11(1)(b), etc. You would have heard in the past, any donation from one non-profit to another non-profit was an application. But restrictions started coming one after another. What is it? First of all, from the accumulated funds by filing form number 10 under section 11(2), no contribution can be given to another entity. Of course, they can give, but it won't be eligible for claiming the exemption through the accumulation. And now, lately, the other restriction is that during the year you can give contribution to another trust, but from the accumulation you cannot give. In addition to that, during the year, if you give corpus donation, it won't be considered as application. Now, each of this amendment is come with a particular background. There is, we all are aware, there are a few people who misuse the provision. For example, if somebody really wants to misuse, for example, if a first trust gets 10 crore income, it can give a corpus to the next, and the next will treat it as a corpus under 11(1)(d). It does not have to apply. Only the interest will come. When the interest comes, it can again accumulate for 5 years, and in the 5th year, it can make to the next trust, and then they also don't have to pay tax. Now, my point is not the capacity, not the exemption they managed. What they have managed is not spending 1 pi for the purpose of the trust. Nothing goes to the people, but tax planning is happening. Now, tax planning, of course, is considered to be a noble activity, none other than by the Honorable Supreme Court. But this kind of tax planning, which does not touch the life of the people, is a question. Therefore, the amendment has come. But unfortunately, genuine organizations where they want to make a genuine corpus in order to make a new entity to be self-sufficient, at least to some extent, that is also now not easy. That is also now becoming difficult. As you are aware, when the law comes to plug one loophole, those who were following that loophole, they multiply the loophole. And those who were following in a genuine way, they get into the problem. Now, I don't want to go further on the additions. You are aware, if you read it, you will understand that 11(1)(b), not able to spend the 1 year accumulation, 11(3), not able to spend the 3 year accumulation, and anonymous, and then disallowable under 13(1)(c). 13(1)(c), you, I think, discussed in detail the related party transactions on the 7th of October. One thing on 13(1)(c) I would like to highlight here. If an individual hit by the 13(3), that is the author, the trustees, the relatives, if he derives an undue benefit from a trust, it is one scenario, perhaps to be discouraged. But if one trust gets donation from another trust, at a later time, this recipient trust gives back some donation to the first trust, they are also hit by the 13(1)(c). Now, possibly, I am not sure on the earlier session you spoke of the Champa Charitable Trust of the Bombay High Court has given a decision as against the special bench decision favorable to the trust. The special bench of the ITAT gave a decision favorable to the assessee, but the Bombay High Court said no, that is also brought within the definition of 13(3)%, and therefore today there are a number of charitable bodies in different parts of the country, particularly western coast of southern India, who are facing this risk of one entity given to another, their own group entity, and that group entity, when they got finally some income, they repay it. They have not considered as a loan. They have considered originally as a contribution. Now also they are returning as a contribution, but they are hit by 13(1)(c). Now, that is another reality. And similarly, income chargeable under 12(2), that is the voluntary contribution, and disallowable under 40A, IA, and 40A. I mean, that is the both TDS and the cash expenditure exceeding rupees 10,000. 40A 3 mischief and 40 small a within brackets IA mischief. They all will be called considered as additions, and they will be brought under 5, serial number 5. Now, we come back to the these other categories. Now, I am coming out of those conditions. I am coming to the unconditionally exempt. Look at this. There are so many bodies. They include Section 21 research bodies. They include welfare funds. They include temples notified by the government. They include devasthanams. They include quite a few bodies who are unconditionally exempt. What do you mean unconditionally exempt? They don't have to register. They don't have to get any approval from the commissioner. They don't have to have 12A. They don't have to follow 11(5). They don't have to even file the return, because you won't find these are covered by 143 4 capital A or 4 capital C. I'm sorry, 139 4 capital A or 4 capital C. Still they are filing the returns. When they want to file the returns, this is the form that is ITR 7, and schedules are like this. Which are the schedules? Schedule amount of exemption in point number 8 and 9 of the schedule part BTI. Any other taxable income like others, house property, BP, etc. Of course, I forgot to mention return filing for some of them is under 4C, some of them, not all of them. Registration or approval is required under any law other than the income tax that is applicable. For example, some of the entities may be registered under the Trade Unions Act, for example. Then they will be covered under the income tax for this exemption purpose. And similarly, there may be other registrations which will enable them to obtain or eligible for the exemption under the Income Tax Act. Now, look at this E1. E1 is income and expenditure statement applicable to assessees claiming this category, 10, 21, etc. Very simple. 3 things they have to fill up. That's all in this form for them. Total receipts, application towards objects, accumulation of income, nothing else, And then, of course, for registered under section 12A, you have to fill up these items, and then again the amount eligible as exemption under 3A, 3A, AB, AB, AC, and AD, AE. For all of them, this here we have to fill up. And then we move on to specific cases, 1023A, certain welfare funds and trade unions. You need their registration. Like trade union is registered under the Trade Union Act. Therefore, you will have that certificate. And return filing is under 4 capital C. Other contribution and income will go to the voluntary contribution, and IE2 has to be filled up for them. This is IE2. In IE2, there is a little more, that is total receipts, application of income towards objects, and accumulation. Then do you have any other income which is taxable? For example, income from property or business and profession, capital gains, other sources are taxable. If they are there, that has to be filled up here. Then we go to the A, B, A, C. We already touched upon that, substantially financed by the government, and the substantial finance is defined in Rule 2 triple B, which says it has to be excess, so exceeding 50%. In these cases, a registration or approval is required under any other law, meaning if they are a school, there will be a school recognition. If they are a college, there will be a recognition from the university or from the UGC, and return is under 439 capital C. Other contribution and income has to be shown as usual under the voluntary contribution. And the schedule is IE3. An assessee claiming exemption under AB is required to file the amount of exemption under 9A of the TI, BTI. An assessee claiming AC is required to fill the amount under 9B of the BTI. Other taxable income, as usual, gross receipts to be filled up under IE3. Why gross receipts? Because that is the criteria here. Grant received from the government and the gross receipt. Why both? Only if both are there, you can see whether it is exceeding the 50%, conforming to Rule 2 triple B, and eligible for exemption under this category. And this is how it is filled. Object of the institution, it will be only two, either education or medical. An address where the activity is carried on, total receipts including voluntary contribution, government grants out of serial number 3, then amount applied for the objective, and the balance accumulated. Key details, just what is required is asked here. And then voluntary contribution to be mandatorily filled up, same as the other local, foreign, etc. And then we go now to the AD and AE, more or less same, excepting the category here is it is below 1 crore, and the previous one is government grant, substantial government grant, which is above 50%. Now here again, registration or approval is required under any other law. Return filing is under 4C, and same for other contribution income to go to voluntary contribution schedule. And IE here is 4, because this is a turnover category below 1 crore. Therefore, IE 4 captures the data which will prove whether the turnover is below or above. Assessee claiming exemption under 1023C, AD is required to fill the amount of exemption in 9C of the BTI. Earlier 9A, 9B, now it is 9C. I am sure here assessee is claiming AE is required to fill the 9D, and other taxable income is required as usual, house property, etc. Gross receipts to be filled up in IE4, because that is the key factor here. Assessee having gross receipts more than 1 crore, then the institution is not eligible to claim under this category, but it has to go to 1023C 6 and 6A. Look at this. E4 asks for objective of the institution. It will be either medical or educational, then address, then gross receipt, then amount applied for objects, and the balance accumulated. And then the VC, if there is other sources available, other income, voluntary contribution, then it has to come here. Now, before I go to the common mistakes, some of these mistakes that we are coming across, one controversy that you would have heard in earlier sessions, if a society or a trust is running multiple institutions, let us say a school and a college and a hospital, whether 1023 AD/AE is applicable for each of the institution or for the society or the trust. There has been a controversy going on. For in the long past, for several years, it was given for each of the institution. Whereas in the last couple of years, 4 to 5 years, I am coming across the department taking a view, sorry, each one of the institution does not have a PAN. You only have a one PAN for your society or your trust. And under the same PAN, you are having multiple institutions. For us, it is PAN. And for a PAN, how much is the total gross receipts? That is what is important. So they are not accepting the earlier position that each of the institution is eligible. But our people are very creative, very, very creative. Some of the institutions, they are only units of the main body, but they have their own PAN. Don't ask me for names now. Huh? I'm also surprised how they got it. They got it. They got it. And we try to tell them, no, for a single body, single society, single trust, you cannot have more than one PAN. It is punishable under section so and so, etc. They say, no, sir, we never asked, sir. They only gave, sir. Who applied, sir? Application is not available, sir. So there are realities and realities in the non-profit sector. We can go on and on, but given the time, I would like to very quickly touch upon these common issues. You may be yourself perhaps facing some of this, so I'll be going very quick on it to give you at least 10 minutes. Income tax returns to be filed 9 1 year, 5 10 for 5 year. We have seen it. 10B for 11, 10BB for total exemption. We have seen it. The mistakes happen there. IT form, audit report to be filed 1 month before, for example. Now we should have filed in October for filing in November, or now it is given December and the return in January. That is the reality now. And UDIN generation is also necessary. When you go to file 10B with your DSC, there is one field that is coming up with the UDIN. Now, two options. One is you generate the UDIN and fill it in, or it says you can generate later. Of course, UDIN itself gives 15 days, as you know. Here also they give time in the portal. If you want to generate later, you can generate later, but you have to open the portal, you have to fill, upload it again. File the IT returns using wrong form is a problem. There are some entities who have used a wrong form for a right exemption. Date of filing the original return not within the due date. If that happens, then the revised return cannot be valid. Original return needs to be e-verified even though a revised return is filed. You may be wondering why I am putting this. I have come across cases, original return filed, afterwards 3 revised return happened within the time limit. The last revised return is e-verified. Original returns have not been original, and the next revised return not e-verified, and that is brought as an issue by the CPC. E-verification of the IT return will be considered only after that only it's a valid return. Date of incorporation can't be later than the date of registration. I am coming across quite a few cases where the date of incorporation is later than the date of registration. Register or PAN number. When you go to the PAN number, that says PAN was obtained in 1996, but the date of registration of the society is much later, 1997 or 1998. This kind of situation is going on. Another one, principal contact, registering the principal contact is so important. If you want OTP, particularly in Corona times, you want to file 9A with OTP, 10 with OTP, and ITR 7 with OTP, unless the principal contact is properly there, and then the primary ID is there, it is not practical. For another aspect is regarding the PAN. There are many PANs which are not having T, the fourth letter as T. T stands for trust. And in income tax, trust is representing society, Section 8 company, or unregistered but registered under 12A, anything. So if T is not there, it's a problem. You may ask, what's the problem? If T is not there, ITR 7 doesn't show up in the portal at all. Last year, I came across a few cases where for last 30 years they have been filing the return, including e-return from 2014. But suddenly last year, it didn't show up the ITR 7, that too towards the end of the last date for filing the return. So frantically contacting different people, etc. Finally, the department advised apply for a new PAN with T. The new PAN came, but it went for a wrong jurisdiction, non-corporate jurisdiction. And somehow, fortunately for this institution, last day the ITR 7 showed up and simply filed the return. And now the new PAN is under operation, but new PAN has to get all the TDS, all the TDS has several lakhs and some cases crores have to be the return has to be refiled by the various deductors, and PAN migration is happening, but that is taking a long time. These are all the live realities just now going on in the non-profit category. Then, of course, checking the previous year, filling the current year Form 10, tracking the investment while we are filling the accumulation is important. Similarly, the utilized money out of the past accumulation has to be carefully filled up. And another aspect is the investment that we fill up in Schedule J. It must match with the total of the investment in the balance sheet. And the corpus and non-corpus, as you know, has to be properly classified and filled up. And then income chargeable under Schedule VC wrongly put in OS in certain cases and gets taxed automatically. Income chargeable under VC and AI wrongly reflecting under the BNP and Schedule BP and also getting taxable, unfortunately. Accumulation under 11(1)A(B) restricted to a minimum of 15. Here, suppose a trust is having 10 crore and it has already applied 11 crore, there is no automatic 15% exemption. It is zero. Only if the trust is actually having some surplus, for example, 90% applied, 10% is a surplus, that has to be filled up in the ITR 7. Also, exactly same way in the Form 10B. But we come across anomalies there. And ensure applicable exemption has been claimed under serial number 1 to 10 of the TI. There are so many different exemptions available there, so we have to carefully select it. And funds were utilized for 1 year accumulation, then fill the column deemed application in any preceding year in the section 11(1)(2) in Schedule ER ITR 7. And of course, TDS. TDS is another really a tedious issue. Very often it is creating problem. For some entities, it is not connecting with the 26AS. And I have come across some entities where there is no place at all to fill the TDS. If the entries are 10 understandable, 100 understandable. I come across an entity where the entries are numerous, some 2000 plus. So there is no place. The utility is not taking it at all. So what they do, they fill up only partly, and the refund also comes partly. Fortunately, file another revised return with the remaining TDS and get the remaining refund. This is also going on. This is another reality. Now, this is again simple but important. If PAN is not linked with the bank account, refund doesn't fall into the bank account. If mobile number and email ID not linked with the bank account, again the refund doesn't come. Refund account, bank account, name of the entity should be matching with the PAN. What do you mean here? You have a trust which is running 2 schools and a college. They are different names. So the bank account is in the name of the college, but the PAN is in the name of the trust, naturally. So when the refund is coming, there is a problem. There is a problem that it doesn't fall. So these are just some of the kind of problems that we are facing. Respected chairperson and my dear friends and respected senior members, these are just some of the thoughts. I remember once when poet Kandasami was asked, how do you find words? நீங்க கவிதை வரும்போது அதுவும் சில டாபிக் கண்ணதாசனோட டாபிக் உங்களுக்கு நல்லா தெரியும் என்னென்ன, எப்படி உங்களுக்கு அவ்வளவு தாட்ஸ் வருதுன்னு கேட்டப்போ அவர் சொன்னாராம், எனக்கு நீங்க சொல்ற மாதிரி பிரச்சனை இல்லை, எனக்கு வருது 1000 இல்லை 10,000 கணக்கில் வருது, எதை விட்டுட்டு எதை சொல்லலாங்கிறது மட்டும்தான் எனக்கு பிரச்சனையா இருக்குது, அதுக்கு நீங்க ஹெல்ப் பண்ணீங்கன்னா எனக்கு உதவியா இருக்கும். Like that, I am in a position now which issue to be highlighted and which issue to be left over, because we are coming across so many issues in the case of non-profits. But what is satisfying is these non-profits, whether they are very efficient or not so efficient, one way or another, especially during the COVID times when the business sector is under tremendous stress, when the government is also under tremendous pressure, the non-profit sector is touching the lives of the society, particularly the vulnerable people. And that is enough for us to give us all the energy, all the encouragement to go all the way to help them. Now here, I do not mean those who are blatantly making mistakes, deliberately misusing the law, they are a special category. I don't think they will come to advise us. Maybe we can take advice from them how not to do it. So our focus is on those NPOs, particularly in the southern part of Tamil Nadu, where so many are relating with the members, asking for help. I hope these thoughts are useful for you to be of help to them. And while I say this, I already admire greatly most of you, so many of the members going in support of these NPOs, especially in Tamil Nadu and more particularly in the southern part of Tamil Nadu. Thank you so much for giving me this opportunity. I am now open, available to you for any questions or clarifications. Thank you.
Okay, sir. Thank you, sir. Thank you so much. Sir, you can stop sharing your screen, sir. Stop sharing. Okay. Sir, I'll share. We have received around 10 to 15 questions, sir, from the members. I have filtered only the questions. I'll be sharing my screen, sir. Meanwhile, I have released the audio controls. T. Ravi, sir, you can raise your query. I'll get ready with
I
that.
can see my good friends, Ravi there, is it?
Yeah. Good evening, sir. Very nice of you, sir.
How are you?
Getting on very well, sir. It was a wonderful presentation, sir.
Nice.
I could recollect the program which we had a few years back at Madurai. I
Right.
think it is high time we should have one such program as to the new procedures of renewal and all that for the trust.
Yeah.
Maybe after the COVID. Okay, not now.
Yeah,
Okay,
yeah,
because
yeah.
physical meet now is not advisable.
Right,
Maybe after
right.
the COVID, maybe sometime during February or March, we'll work on it.
Yeah,
Maybe
yeah.
you can also influence the departmental officials and the exhibition in Chennai to
Yeah,
organize
yeah.
for a program so that
Right.
we'll have a good gathering and all the institutions in southern Tamil Nadu will be benefited by your wonderful thing
Absolutely.
presentation. We'll work on that, sir.
Absolutely, Ravi. Absolutely, Ravi. I remember the huge number. The largest participation was in Madurai. I think it was in Madisha, isn't it? In the
Yes,
Madisha.
sir. Yes, sir.
Yeah.
When I was chairing it, we were able to do it with the
Yeah.
support of Daniel and
Yeah.
Francis. We were all there.
Yeah. Yeah.
It was a wonderful program.
Unforgettable. Unforgettable. And the commissioner then in office always remembers that what a gathering it was. One of the best and very, very, I mean, very radiant set of people with a lot of vibrance. And he always used to. You remember, he assured a lady who cried there, tomorrow I will give you the ATG.
Yes.
And he gave the ATG the next day.
Yeah. They subsequently even thanked us, sir. Okay,
Yeah.
they said it was only in this forum they were able to get it done.
That's right. That's right.
Okay.
That's right.
And that's very nice of you, sir. And coming to a few issues.
Sure.
Okay.
Sure. Yep.
Right now, like already when trusts are being now established or created, we do the registration
Yes.
with the sub-registrar. Okay.
Yes.
Then what is going to be different under the Public Trust Act after its introduction? You said one more registration.
Yeah.
Maybe they're trying to streamline the existing registration. What they're doing it,
Yeah,
they will be trying to bring under that Tamil Nadu Public Trust Act also.
Yeah.
We're not sure about
Yeah.
it. We'll have to see.
Ravi, actually, you are touching the nerve center. See, when we register a society or a trust at the moment, we are connecting with a government official. For example, as you rightly said, when we register a trust deed, we go to the sub-registrar and we pay whatever small stamp duty according to the corpus donation there, or if there is a initial corpus immovable property, etc. We use that and then we pay the stamp duty and we register, and we also get a document number, 100 of 2020 or whatever, and that number we are quoting it for various purposes. Unfortunately, this is coming up as a completely additional to all of that. In addition to all of that, same way as an analogy, if you go to the society, we take the memorandum and bylaws of the society to the Register of Societies, who is sitting there in the same district registrar office, and we get the society registered, and we have a certificate of registration, and we also have a number of the society. For example, 20 of 2001 or 2002 or whatever. Now, this is coming up as a completely new addition to all of that. This is exactly what is happened in Maharashtra. Though they are all registered under the Maharashtra Societies Act and then the Indian Trust Act, etc., they were all asked to re-register under the Bombay Public Trust Act. So they are bringing up same. And one more thing, they are going to maintain register of trust. Right now, there is no register of trust, because the current registration is under the Registration Act, Indian Registration Act. And therefore, they don't keep any register of public trust. Now, once this bill becomes a law, they will make a register of trust, just like they are having a register of societies. So it is going to be a completely parallel administration like that of the society registrar.
Okay, sir. We'll look for it, sir.
Yeah.
We have a lot of questions thrown before you, sir. Maybe we'll go through the questions because they're eagerly waiting for the replies.
Okay, please. Yeah.
Sir, you can able to see the questions, sir. I have filtered only the questions queries. Sir, is it audible?
Am I still audible?
Yes, sir, audible. You can see the questions, right, sir, in the screen.
சார் கொஸ்டின்ஸ் வந்து ஸ்கிரீன்ல இருக்கு சார், தெரியுதுங்களா சார்?
என்னோட ஸ்கிரீன் கொஞ்சம் இதாயிட்டுது டேனி.
சார் சேர்மன் வாசிக்கலாமே.
கொஞ்சம் சொல்றீங்களா? நான் வந்துட்டுதுன்னா நான் சொல்லிடுறேன்.
ஓகே சார்.
If you don't mind, could you kindly help me?
Yes sir, sure sir, I can read it sir.
Please.
Okay, sir. Over to you, sir. That means.
Yeah, thank you chairman. If you want to get approval for spending more than 20% for administrative expenses,
yes,
to whom should we apply, and is there any prescribed form for the same?
I think Madurai members have a specialty to ask exactly the right questions. As of now, FCRA has not prescribed any form or also mentioned whom to apply. But as you are aware, anything we want, we apply to the FCRA. The emails are there, the email IDs are there, FCRA DS, FCRA Director, and FCRA Support. So whenever I come across anything like this where there is no specific mention, I advise them, copy to all the email IDs. And right from Madurai recently, somebody did that. Unfortunately, from one ID, reply came. Other IDs, there was no reply. And then I advised them to follow up through the same ID, and they are communicating with the FCRA and things are going in the right direction. But that is not for asking for permission for administration. That is permission for surrender of the FCRA. Yes.
Second one, sir.
Yes.
CA
Yes,
Vijayan. Yes, Mr. CA Vijayan.
Yes,
Investment pattern is different from that of Income Tax Act with the Tamil Nadu Public Trust. How to manage funds either as per IT Act or Tamil Nadu Public Trust Act? Your view, please.
Good question. For that matter, if you look up 2-3 acts which are regulating the non-profit, if you go to Societies Act, Tamil Nadu Societies Act, that also has set of investment pattern, if you don't mind me, CA Vijayan, I would like to suggest not to follow any of those strictly. What do I mean by that? For example, the income tax allows also what is called mutual funds.
Yes.
But you know the question. You know the risk involved in the mutual funds.
Yes.
Many people have lost crores in the mutual funds.
Of course, I am very glad to say that we have not lost a single pie. The trust for having invested in mutual funds.
That means they have really been fortunate, and therefore, what I would like to say, decide the investment based on other factors such as the income, ROI, capital appreciation, and then the nature of funds, whether our fund is capital fund, corpus fund, endowment fund, or needed for certain scholarship, income is needed, etc. And see whether that one or two options you come up finally is definitely fitting under both the Trust Act and the Income Tax Act. That's the way. That's the way I have been approaching. So I am just sharing with you how I have been approaching the portfolio for investments of non-profits.
Okay, thank you.
Hope it makes some sense for you.
Right. Then I have got another one question.
Yes, sure.
That is trustee. One of the trustees is a British citizen and holding OCA card.
Okay.
Now the TN Public Trust Act says that only citizen of India can be the trustee.
Yeah.
Then is it possible, because he is a resident in India always, there is no question of going to the foreign country, or he is a resident in India only, holding OCA card, but a person of a British citizen. Then how to manage that?
Thanks for highlighting this. I was feeling somewhere in my heart, in one part of my heart, I am missing that point, because I myself have quite a few people from other countries, both of the west and the other eastern part of the world. They are here in India for the last 40 years, 50 years. They are in the last part of their life cycle also. And they are actually the founders of some of the important non-profits. So are doing wonderfully today. Unfortunately, this law, if it comes as it is, they will be ineligible. They will be disqualified to continue to be a trustee. I highlighted more on the other set of people, that is, people who have gone and settled abroad, and the children born there in that country, because, as you know, when the children born in certain country like United States, they are becoming citizen of that country. That's a very special status they get there. And they are still, their heart and their soul is here in Tamil Nadu, and they are having trust. They are also disqualified. They are getting disqualified. So you will be the right person for South India, southern part of Tamil Nadu, to motivate people who have this situation to make a representation.
Okay, thank you.
What is wrong?
Definitely, we will make a necessary representation to the government to make the resident non-citizen.
Exactly. That
is what.
And similarly, those people who are the citizens there, like you said, OCI, they are PIO.
Yes, definitely.
See, as you know, PIO is for those who are originally person of Indian, but they are there with their citizenship. Now, OCI is just the diametrically opposite scenario, what you are bringing up. Both are eligible, I suppose. Both are coming into the trust, not doing business. They are doing business well in their own way. They are coming into trust to do some service, isn't it?
Correct.
So I think it is really an important point that we should help those people to take it up with the government.
Right, sir. Thank you very much.
You're welcome.
Next question is from CA Vimala.
Okay.
Is Tamil Nadu Public Trust Act applicable to the existing trust already registered with the Trust Act? When societies are also covered under this act, then what is the purpose of Society Registration Act?
Good question. See, as you are already hearing, that within 3 months after the law comes into effect, all the existing trusts have to register. That is one provision. And when you go to the definition of trust in this bill, it also covers, after long so many things, it also covers society. Unfortunately, I don't understand the rationale, because the Societies has got parallel provisions. The Societies Act has a register. The Societies Act got a provision for monitoring, inspection. The Societies Act has got provision for appointing special officer. You may be aware there are some societies, popular societies. The government has appointed special officers, but they are also covered. This is another area for representation. I do not see, I don't know if any of our members gathered here can see another point, but I do not see any additional point in simply bringing the societies who are already in a similar set of monitoring, similar set of regulation in the state, through the covering through the provisions of the Trust Act. I do agree with her CA Vimala's concern or point that it is unnecessary. It is unnecessary. Somebody in a last session, in another session, made a very strong comment. Very strong comment. I don't feel like repeating it, but I think it is another area for representation.
The next question is from CA Ganga Kristas.
Okay.
Will this bill be applicable to Provident Fund Trust?
Beautiful question. Beautiful question. Fortunately, not covering CA Ganga. Fortunately, right now, when you go to the definition, it is not covering. And also, fortunately, a Provident Fund Trust is not a public trust in the nature. In a Provident Fund Trust is covered, as you know, by the Schedule 4 of the Income Tax Act. Schedule 4. Schedule 4 speaks of 3 trusts. One is the Provident Fund Trust, another is the Gratuity Trust, third is the Superannuation Trust. So this is governed by the provisions of Schedule 4, and it is a restricted purpose. What is the restricted purpose? Employees, member of the employee category of an organization, for which separate regulations are there. The Provident Fund Act is there, and then the Income Tax Act is there. Both are having provisions for so many restrictions. And you may be aware lately, since 2015, 1/4/2015, Provident funds set up by non-profit organizations are not given the exemption under the Income Tax Act. You may be aware. Because the government was going on giving extension until 31st March 2015 for registration of these kind of Provident Fund Trust under the Provident Fund Act. And government stopped that extension from 1/4/2015. So I have number of Provident Fund Trust which were beautifully operating for non-profit organizations without any difficulty. They have all now gone back to the Provident Fund Commissioner. This is another point I am adding. But straight answer is Tamil Nadu Public Trust Act does not cover the Provident Fund Trust at all.
The next question is from CA Harindra.
Okay.
Where do we show application made out of excess application brought forward from earlier years?
Excess
application.
Excess application. Unfortunately, you are right. There is no place as of now. There is no place as of now. I do not see in the ITR 7 still. The government is going on asking for representation, asking for inputs. Even recently, I had a request last week. We've been continuously, without any hesitation, I've been giving number of requests. Danny, Ravi, you are all familiar. Every year, every time when the commissioner was in interaction, we were asked to give representation. I think this is an area, though Supreme Court has rendered the decision that you can carry forward and the Supro's case, there is no place right now to do it.
Next question is from CA Parthiban. A trust registered under Section 12A is getting major income through renting out of marriage hall. Can it be treated as income incidental to object, or should we offer it as an income taxable under the other sources?
Income from property owned by a trust registered granted registration under 12A should not be taken to income from business or income from other sources. It should be income from property. As you are aware, long time since, since the time of Kalavala Charities case of the Madras High Court in the 60s and 70s, income, as also you heard in the October 7th session, the definition of total income that is applicable to other assessees is not applicable to a trust. So for a trust, when I say trust, it includes society and Section 8 company, everything. The income has to be in its commercial sense. And that was the judicial view consistently, and that has not been disputed. So income from property should be not going to other sources, not going to business or profession. Unfortunately, there is a tendency to tax the marriage halls as a business. not because of the 12A or category of income. There is a kind of an impression. There are marriage halls where the daily rent is 10 lakhs to 30 lakhs to 50 lakhs to and more. So that is unfortunate, because there are if there is one hall like that, 99 halls are there to help the poor people to get married. Small marriage halls attached to a temple, attached to a church or a mosque, etc. Small marriage halls where hardly there is small income, which is not even enough to maintain the marriage hall. But as you are aware, in Coimbatore group, there is a beautiful institution, large set of institutions, but because of one big marriage hall, they went into tax issue. So if you would like to kind of make this entity or safe tax exemption, I would make a small suggestion. Separate the, that marriage related expenditure and income completely through a lease arrangement or whatever, and make sure the income for the trust is a monthly rent or whatever, a quarterly rent or annual rent. Then you can 100% prove I have nothing to do with the marriage activity. That is being organized separately. What I get is a rent for the property owned by the trust. I can assure you safety. I hope this gives you some useful information.
Next question is from CA Vimala. When a parent society accumulates its surplus after 85% application under section 11.2 or a period of 5 years in the assessment year 17-18 with the purpose of construction or renovation of buildings, then there are sub questions. One, can the excess expenditure of assessment year 18-19, 19-20 spent on the objects be set off against its accumulation?
Of course, under income tax, each year has to be dealt separately. So in 17-18, there was surplus, and you have used 11.2 provisions of 11.2, and you have given a clear purpose there, that is repairs and etc. And you have filed a form 10. You have got also deposit. The fact next year you have got excess expenditure. Is it, Danny?
Yes, excess expenditure, sir.
Okay, and that is used for?
Can it be used for that accumulation, which is meant for construction or renovation?
To set off against the 17-18 assessment year 17-18 accumulation?
Yes, sir.
No. Why do you call that an excess expenditure? Why do you call it excess expenditure? You have accumulated for a purpose in 17-18, that is the earlier year. And in the next year, there is already a expenditure towards repairs and maintenance. If you have not clearly mentioned it is for A property or C property, it is for the properties of the trust, then what you accumulated for, you are also spending in the next year, isn't it? So
I think might be she is meaning that excess expenditure on the revenue expenses, I think, sir. I think she would have mentioned that.
Then there'll be a little problem, because
yes,
as
sir.
you must have already discussed in your earlier sessions also, the department is quite particular that the purpose has to be clear. I think you highlighted it also. I remember, Danny, in your session. The purpose has to be clear, and the same purpose should be taken care. It should be used for the same purpose in the subsequent year. If you can prove it is for the same purpose in the subsequent year or the year after, and if you can establish the nexus between the two, and if you have used the accumulated funds by withdrawing the deposit, then you can go for you can set it off. But if that is a problem, then you are running into a risk.
So can the accumulated purpose can be modified, sir, with the permission of the officer?
Of course. See capital 3A, capital A, 11 subsection 3 capital A allows an assessee to modify the object. Modify the purpose. But it has to be justified. It has to be justified. For example, I have so many examples where most of them went through, but in one or two there were questions. For example, somebody accumulated for construction of a big training center, and in that year they did not do it, and in the next year also they did not do it, and they came to the 5th year, almost end. That year they wanted to change it. Then this purpose was construction, and the reason given was that the approval for construction was denied. And when the date was looked into, the date was right in the first year. Why you waited for 3 years or almost 4 years to come to the department for change of the objective? Now the answer was, we reapply, we tried again to get the approval from the government. Approval, as you know, takes long time. But unfortunately, there was no proof for the reapplication. I hope I'm communicating a special situation. If you have a clear, if there is a supporting evidence document that there is a genuine reason that they could not apply earlier, but within the time 5 years they go for the change of purpose, then there is no difficulty. We have been getting that.
Second question, sir, sub-question.
Yes.
Can the parent society do construction or renovation activities for other societies having similar objects out of the accumulated funds?
Unfortunately, it will be hit by the mischief, no? Now, as you are aware, accumulated funds cannot be transferred to any other entity. It has to be utilized only by that entity. On the other hand, what can happen if the property on which construction has to be carried out is leased to the parent body, and permission is obtained to construct on it, then there is no problem, because parent body gets the right legally to put up the building. They can go on that.
And sub-question 3, sir, when there are funds unspent in the accumulation and it becomes taxable, then can this income be treated as income eligible for 85% application or otherwise, and what is the rate of tax?
Now, it will be MMR. It won't be eligible again for to be treated as income, because it is a violated income.
Yes.
It's a violated income, so it will be treated for MMR. Any violated income, as you know, under here or 11.1D, sorry, 13.1D, read with 11.5, 13.1C, etc., will be attracting MMR.
Yes.
Then இது என்னது 11 subsection மாதிரியே போகுது questions கூட.
Yes, sir. Is it necessary to continue in the same mode of investment specified in 11.5 already existing, or can we modify the investment pattern within the specified mode year after year?
Very interesting. I must congratulate this for this query, because in my last few decades, I have never ever received this kind of a query. I have also not thought about it. I think there is absolutely no prohibition, because the requirement under section 11.2 read with 11.5 is that it should be in the one of the modes prescribed under 11.5.
Yes.
So if you modify from one to the other, luckily the question is not after a long gap, it is modification, no?
Yes, sir. The same for person, sir. C.A. Vimala, she has asked for that.
No, it's a good question. It's a good question. Why not? Because if you see that you have put in a deposit with 6%, now you are able to get 7.5%, and another deposit or another mode like a government company or whatever, then of course you are free to do that. The other way around is very important. There should be withdrawal of the deposit when we show that it is utilized.
Yes, sir. This question is something related to the earlier one, sir. When we want to change the purpose of accumulation or add further purpose, which form we should apply to the income tax department? Is there any possibility for an officer to reject the application, and if rejected, shall we have the opportunity to go for a writ petition?
Taking the last first writ petition, we can go for anything, because 226, no, we allow anything. We can go for writ petition. There is no question. But going back to the first aspect, I mean, as of now, there is no provision in the portal for a change of purpose. So in my experience, what we have been doing, we are applying, we are applying only a hard print. And of course, they come up with a big questionnaire they come up with when we apply for a modification. And those questionnaires are very interesting. They are asking about, whole lot of like assessment questionnaire. What is the surplus? Why did you make the surplus? And why did you apply for accumulate? And what for you did it? Why you could not do it? And why you did not ask in the earlier year itself? Why you delayed for last 3 years? So I get that kind of a questionnaire. But when we are able to give a good reply, the answers have been positive. The orders have been positive.
Next question from CAM Lakshmanan.
Okay.
Due to the delay in filing Form 10 in AOI assessment year 16-17,
yes,
the AO didn't allow the accumulation and taxed it.
Right.
Though the CBDT by its circular dated 2010-2018 given powers to the CIT to condone the delay, the CIT is not prepared to allow the condonation since the assessee has gone in for an appeal and the CIT appeal is also not prepared to pass the order since condonation petition is pending with the CIT.
நீங்க இத சொல்றீங்களா இல்ல அக்டோபர் 7 அப்படியே ரீப்ளே பண்றீங்களா?
Sir, இதுல இருக்கு சார் கேள்வி.
I know, I'm joking.
Yes, sir.
I remember that you discussed this. I think you discussed this earlier, illa?
Yes, sir.
This kind of a situation I have come across so many times. Not only in a case like this, but also in 264. 264. You are all familiar, no? With 264, we go to the CIT for a revisional order, So, of course, one question that will come up is, commissioner will say, while the appeal is in force, I cannot have jurisdiction for my order. Then what you will have to say, I will withdraw the appeal and you will have jurisdiction. And then immediately, what next question will come? Do I have a guarantee that the order of the commissioner will be favorable after I withdraw the appeal? So where are we now? We are between the devil and the deep sea. So here you have to take a call in relation to your interaction with the commissioner. What is your gut feeling? If you have a feeling that it is going to be favorable, then I think you can withdraw, but it is a little risk that you are taking between the time that you have this interaction and another 1 or 2 days. There can be a different person coming there. Nowadays anything is possible. Not only that, when we go for faceless assessment and faceless appeal, then where is the interaction? We are still debating about the video conference, etc. Am I right? So it is going to be a difficult situation. I don't think I have a straight answer, but I have faced it so many times in other situations of 264. I've always found when I was convinced that the commissioner is when I am convinced that the commissioner is convinced, I have withdrawn the appeal. When I was not sure that the commissioner is convinced, it is only a kind of a gamble, then I was not withdrawing the appeal. So I will leave it at that.
Next question from CA Fernando.
Okay.
Section 11, subsection 5, class 3 allows deposit in any account with a scheduled bank to be qualified for 11.2.
That's true.
However, Schedule J of ITR 7 mandatorily asks for maturity date of investments.
Yes.
Does it imply that the deposit necessarily to be a time deposit, fixed deposit, which is not the requirement of Act?
Yeah. Beautiful question. I think is it Charles Fernando?
That name part is missing, sir. It must be Charles. Only sir. It must be the Charles sir only, sir.
Okay. So it's a beautiful question because many have not identified this particular aspect. He has gone to that. Really, the 11.2 does not speak about only fixed deposit at all. 11.2 only speaks about one of the modes of section 11.5. So when one of the modes of section 11.5 is also a savings account, bank account or a current account, there is no compulsion that we only have to go for the FD. In fact, there are organizations, for example, I have right now an organization who is going for a community call construction, which is 1 crore. And because of the corona, because of the labor is not available easily, the migrant labor has all gone off to their places. They are compelled now somehow to construct it within the March ending. There is no use for them to put fixed deposits now. They can only put fixed deposit for 15 days and 20 days and 1 month or 1.5 months or 2 months. Therefore, they can keep it in the savings bank account. But when it comes to the maturity date and deposit, that is a different thing. In the ITR 7, if you have a FD, then you have to put a maturity date. If you have a non-FD bank account, then it is only you have to put IFSC code. There is no need for giving the maturity date.
So the question, yes, sir.
Actually,
the question
it is
is
not
Charles
Fernando, sir. It is Xavier Fernando from Tootukurin.
Tootukurin, sir. Yes, sir.
Oh, okay. So,
the next question is from CA Harindra. Can a 12A trust invest in Power Finance Corporation bonds?
Absolutely, sir. Absolutely. CA Harindra, no problem. They are well covered under the section 11.5. Quite a few non-profits have done it. ஆனா என்ன பிரச்சனைனா கன்ஃபர்மேஷன் சர்டிஃபிகேட்டே வாங்க முடியாது. We go after them, to get the confirmation certificate. So there are some difficulties, practical difficulties like that, but you will find the interest rate is a little more, 1%, 1.5% more than the other options.
The next question is from CAM Lakshmanan. Whether benefit of accumulation under section 11.2 can be denied simply because the amount set apart is lying in SB account of the bank?
Not at all. This is what I was trying to highlight earlier. See, the decision of the trustees to keep it in the savings bank account or a term deposit is the decision of the trustees. There is no need for anyone else to be taking that decision. Where they can go wrong, if it is not within the modes of 11.5, then there is a violation. Like the example that I gave is a live example. Before March, they have to complete it. Now it is a rainy season. Labor is not available. They may have to complete it whenever the rain is better. They are able to get the staff, and it is a very nebulous situation. So in the nebulous situation, if you put on fixed deposit, the manager will say, sir, don't take it, sir, keep it, sir. My year ending is coming, sir, etc. So there is no such requirement at all.
Can investment in fixed deposit can be treated as application and be reported under Schedule EC?
No, only for 11.1 capital A. 11.1 capital A, when it is a capital gains, net consideration is taken as a new asset is fixed deposit, not otherwise.
Can a welfare association registered under TN Society Registration Act and having 12A registration can file its return in ITR 5 instead of ITR 7 under the principle of mutuality? What will happen to 12A registration if return is filed under ITR 5?
We need to take definitely this deserves to be taken up as a research project, Danny.
Yes, sir.
I compliment him for asking this, but I would dare to, just play some thoughts, because I have quite a few like that. If I mention the name, whole world will know which entity I'm talking about. So I would like to just throw some light on it. It may not be the full answer. Number one, first of all, if it's a welfare association, could you confirm from our CA?
Lakshmanan sir.
Sir, it is a membership-based body. Membership-based body, meaning the members. There will be members like a sangam. Sangam madri members irukra oru body pathiya solranga.
Muralidharan sir க்கு நீங்க unmute
sir எல்லாம் அவங்களே unmute பண்ணிக்கலாம். sir
membership bodyயா இல்ல வெறும் அதாவது டொனேஷன் வாங்குற பாடியா இல்ல மெம்பர்ஷிப் பாடி வேர் மெம்பர்ஸ் will be contributing?
membership fees மட்டும் தான் சார். monthly maintenance charges.
Are we getting an idea?
They say it is a membership body getting subscription, sir.
Okay, wonderful. It's a fantastic clarity. See, when a membership body getting subscription, first of all, mutuality principle is a best fit, because they are all getting, they are all members and they are giving subscription. Even if some extra money has to be given, it is coming from the members only. Therefore, it will squarely fall within the principle of mutuality. Now, when it is falling within the principle of mutuality, there is no public element, first of all. But if you apply to the income tax department saying that it is such a body, it is possible that we may get a 12A. We have got 12A for quite a few mutuality bodies. But at some point of time, when an officer is scrutinizing, he will declare and say this is not a public trust. There are decisions and decisions. What is public and what is not public. So a mutuality, if you want to hold on to a mutuality, then it is not advisable to go for 12A or 12AA or 12AB that is coming up now. That is number one. Number two, if you are going to make it open to others, like for example, those set of people, whether it is a physically challenged people, or whether it is a category of artists or a musicians or whatever, not only for those who will become member of this association, then of course you are eligible to go for 12A. And you can hold on to 12A, and then you can go for donations, you can go for contributions, etc. And you can use all the provisions starting from section 215 to section 13. Hope I have not added to the confusion, Danny.
No, sir, it's clear, sir. I think with that, all the questions are answered, sir. Yes, sir.
Okay. I'm really grateful, because I see that you have taken so much of time beyond the prescribed time to bring out live issues. I know that each of the question is a live question that you are facing. I only would like to say, any advice or a support to any of these bodies who have these issues is a real mitigation of the suffocation or the risk that they are going through, particularly at these difficult times of the COVID era. So I must thank each and every one of you for bringing so many very, very live questions, particularly looking at the nuances of the Income Tax Act, as well as the upcoming, hopefully not coming, the Public Trust Act, and as well as, of course, the amended provisions of the FCRA. I would like to thank each and every one of you, and Danny, for it's such a great feeling for me that you were moderating and you were introducing, and we have been learning together for so many years. And Madurai, I always consider to be the resource center for the NPOs, and you have proved once more that it is the resource center. And Chairperson, many thanks and hearty congratulations to you and your team members. Thank you so much.
Thank you, sir. Thank you for your excellent presentation. I think we could have made the session to 3 hours, because question answer session itself went for around 30 minutes. We'll plan some other time, sir, with elaborate session. Today, Mohan Sundaram, sir, our secretary, is not present. He could not make his presence due to his some other personal commitment. So I request our coordinator, our panelists, and our past chairman of Madurai branch, CA Daniel, sir, to give a closing remarks.
Was I audible? Can we close? Are we closing?
Yes, sir. Yes, sir. Daniel, sir, over to you.
Sir, ரொம்ப தேங்க்ஸ் சார். ரொம்ப சிறப்பாக இருந்தது சார். கிட்டத்தட்ட 40 minutes எக்ஸ்ட்ரா ஆயிடுச்சு சார் பியாண்ட் த செஷன், அண்ட் பியூர்லி ஆன் த கொஸ்டின் ஆன்சர் செஷன். ஸோ ஐ திங்க் தட் இஸ் அட்ரஸிங் தி ரியல் இஷ்யூ ஆஃப் த பீப்புள் சார். தேங்க்யூ வெரி மச் சார். அண்ட் ஆல் த 3 parts, FCRA and Public Trust Act and this ITR 7, it has given a very good clarity, sir. Thank you very much, sir, for your time and the knowledge sharing. Thank you, sir, from all the members of Madurai branch and office bearers, sir.
Thank you. Thank you so much. Thanks a lot. All the best. Stay safe and healthy. Thank you so much. Bye-bye.
Thank you, sir. Thank you, sir.